Okay, so you're probably hearing a lot more about commodities lately. Maybe wondering what exactly that means.
Yeah, it pops up a lot.
So this deep dive, we want to give you the quick rundown, sort of cut through the jargon.
Get straight to the basics.
Exactly. We'll tackle, like, what are commodities? How do we group them?
And which ones get traded the most?
Right. And maybe the big one.
Hmm.
How is investing here different from, stocks and bonds?
It's a really different world. Fascinating, though. Commodities are, well, they're the bedrock, right? The actual raw materials.
Agricultural stuff?
The fundamental building blocks.
Totally. And we can group them. Think energy first.
Like crude oil, natural gas.
Exactly. Then you've got agriculture. That's your corn, wheat, coffee beans, things like that.
Okay.
And metals, gold, silver, copper, aluminum, all that.
So these basic ingredients, when we talk about the ones that get traded a lot, what are the main examples?
Well, crude oil is huge.
Yeah.
Always in the news, right?
Yeah.
It powers everything.
Can't miss that one. Gold's another major one. People often run to it when things feel uncertain. A safe haven, they call it.
Okay.
And then basic food stuff like corn and wheat. Absolutely essential, feeding the world.
Right. So let's get into the investing side.
Hmm.
How is putting money into, I don't know, actual oil different from buying shares in BP or Shell?
Ah, yeah, that's the fundamental difference. A stock means you own a little piece of a company. It's potential future profits.
Okay.
A bond, you're basically lending money. To a government, maybe a company.
Right.
Commodities, though.
Yes.
You're dealing with the raw goods themselves. In theory, at least.
So their prices move for different reasons,
Mhm.
not just company performance or interest rates.
Precisely. It's driven by other factors entirely.
Which brings us to, well, you're not actually buying barrels of oil and storing them usually.
Huh. No, definitely not for most people.
This is where futures contracts come in, right? What's the deal there?
Yes, that's key. Most commodity trading happens through futures contracts.
Okay, what are they? Simply put.
Think of it like pre-ordering. A buyer and seller agree today on a price for a certain amount of a commodity, like corn, to be delivered way off in the future.
Ah, okay. So locking in a price.
Exactly. It helps farmers, producers manage their price risk and lets investors bet on where prices might go without needing a silo.
Okay, much better than picturing my garage full of soybeans. So what actually makes commodity prices jump around? Like oil.
Oh, lots of things. For agriculture, it's often the weather. A bad drought, crop yields down, prices up. Simple as that sometimes.
Makes sense.
Then geopolitical events,
Mm.
big time. A conflict somewhere could disrupt oil supplies, for instance.
Yeah, you see that.
But underpinning it all, it always comes back to basic supply and demand.
The classic economic seesaw, right?
That's it. If everyone suddenly needs more heating oil because of a cold snap and the supply is
The
fixed,
demand goes up, price follows.
bingo. Or think about, say, a hurricane hitting the Gulf Coast.
Shuts down oil rigs.
Temporarily, yeah. So less supply hits the market and prices often spike.
Okay, so for regular people like you or me, how do we invest without needing a giant warehouse?
Right. For most investors, the easiest ways are things like ETFs, exchange-traded funds, or mutual funds.
Funds that focus on commodities.
Yeah, they might hold futures contracts or sometimes shares in commodity-producing companies.
Yeah.
It gives you exposure without the headache of physical delivery or direct futures trading.
Got it. So stick to the funds, generally.
For most individuals, definitely.
And we keep circling back to supply and demand. It really seems central.
It absolutely is. It's the core driver. If global growth picks up and more factories need copper,
Demand rises if supply doesn't keep up.
price goes up. And the reverse is true too. Big harvest, lots of supply, maybe prices fall if demand doesn't match. It's this constant push and pull.
Creates those price swings.
Exactly. Volatility.
Now, I've also heard commodities can be a hedge against inflation. Is that true?
It can be, sometimes. The thinking is, as the general cost of everything rises, that's inflation, the raw materials needed to make those things should also get more expensive, right?
Okay, logical.
So commodities might hold their value or even increase when inflation is high, but it's not a guarantee, not a perfect relationship. Other market stuff still matters a lot.
So, not a magic bullet for inflation. What are the main risks, then, if you invest in this area?
Well, the biggest one is that price volatility we just mentioned.
The swings.
Yeah, prices can change really fast, really significantly, because they react to weather, politics, supply shocks, all sorts of unpredictable stuff.
Okay, so let's recap quickly. Commodities, basic raw materials, energy, metals, agriculture.
Yep, the fundamentals.
Investing is different from stocks and bonds, often uses futures contracts.
Right, that's the main mechanism.
Price is driven mostly by supply and demand, plus things like weather and global events.
Real core drivers.
And for most people, investing means using funds like ETFs, but
Mhm.
you have to be ready for potential price volatility.
That sums it up well. And it's worth thinking about, these materials are in everything. The gas
Hmm.
in your car, the food you eat, the phone in your hand. Understanding these markets gives you a really interesting lens on the whole global economy. Makes you wonder, what else could possibly shift the price of something as everyday as your morning coffee, beyond just the obvious stuff?